Uh, there's a lot of commentary about the result on Australian GDP for the June quarter, which compares it to very low levels of growth that we saw way back in the 1990s. But I think to understand what's happening, it's really good to look at the experience that the Australian economy has been through since 1919 and the enormous variation in growth that we've been through, and understand how we, as a result of that enormous variation, get to where we are in terms of government policy, in terms of particularly the previous government. These variations in GDP are by far the largest variations in the Australian economy in my working lifetime. We had in 2020 a slump in activity as the economy was shut down where GDP fell by 6.1%, easily the biggest, I think, since the 1930s of any fall. Then, as the economy then recovered, it recovered up to a rate of growth, year-on-year rate of growth, for the year to June 2021. I mean, we've just reported on June 2024 as being 1% growth. Well, the growth rate in June 2021 was 10.6%, which is overwhelmingly the largest growth rate in either wartime or peacetime recorded since the national accounts have existed in Australia. What then happens is you'll see in the chart that 10.6% growth is the big bump. But what's really important is that's the second bump that you see in 2022, which is actually in the third quarter of 2022, because two important things happened directly before that, in that little low patch of growth just before that second peak. And the first thing that happens, and they happen on in the first quarter of 2022, the second quarter of 2022, and the peak happens in the third quarter of 2022. What happens in the first quarter of 2022 is that Anthony Albanese gets elected Australian Prime Minister. What happens after that, directly after that, is that the Australian Commodity Index, published by the Reserve Bank of Australia, the RBA index, reaches its all-time historical peak, all-time highest ever level in the second quarter of 2022. And what that means is the resource earnings, not just resource earnings, but the revenue that government will receive as a result of commodity exports, reaches its highest level in the period following that peak. And that's really important for understanding what then happens in Australian economic policy. So we have the re-acceleration of growth of in 2022 third quarter to 5.8%, and a much higher level, and then you have a budget the following year. And the budget the following year, you've got the highest revenues ever for a federal government, according to a commentary in the Financial Review yesterday by an excellent economist called Stephen Hamilton. What's actually happening here is that income goes up by about 2% of GDP. That is about 50 billion a year more than you would normally expect in a normal cycle. Now, in a similar circumstance to that, back in the early 1950s, when the Menzies government at that time is faced by the previous biggest ever commodity boom in Australian history, which happens after World War II. Some people call it the wool boom. Some people call it the Korean War boom. What the government decides to do is to run a budget surplus of 2% of GDP. So that so if they were in power now, and of course they wouldn't, they couldn't be, what would have happened is that extra $50 billion of revenue that the Australian government was getting from that all-time record peak in commodities would have been saved, would have gone into a surplus, okay? Because as everybody knows, long-term commodity peaks can't last, right? And, but again, as Stephen Hamilton has noted yesterday in the AFR, what's actually happened is that the government decide to increase their spending to the level of the revenue. And you can see that in the budget papers where they say they, Jim Chalmers announces that he's making a surplus, but if you look at it, it's a wafer-thin surplus, that really he's making all this money and he's spending all this money, and there's a very shallow, tiny surplus of a fraction of 1% of GDP. And then what happens is that the commodity prices start to fall. And as commodity prices start to fall, then the revenue that the government is having starts to fall. As the economy slows, what happens is that peak in 5.8% in the third quarter of 2022 is followed by year-on-year growth, which falls very, very smartly to in 2022, for the full year, growth is 2.6%. In 2023, for the full year, growth is 1.6%. And for the year to June, which we've just seen, growth is only 1%. So the economy has slowed down, commodity prices have fallen. And in the most recent budget papers, what we've seen is that Jim Chalmers is budgeting for a deficit of 1% of GDP. And now we have that debate opening up between the Treasury and the RBA, with the Treasury blaming the RBA for inflation. But really what's actually happening is because the Treasury has decided to spend the money, there's extra stimulus, at least 1% of GDP. And I think structurally what Stephen Hamilton's piece yesterday is showing us is that there is a kind of long-term structural deficit being built in of around about 2% of GDP by the government. So as you go forward, that structural deficit will start to appear in the budget papers, which means that for an economist, this is a really interesting time to live in. Now, in terms of what's actually happening in GDP, one of the things I did during the beginning of the pandemic, together with another economist called Brendan Markey-Tower, we did some research into what I call nowcasting the Australian economy, or nowcasting GDP from employment numbers. Now, I've shown over previous weeks charts of employment growth and how when it's higher than the long-term trend, you expect rates to go up. When it's lower than the long-term trend, you expect rates to go down. Well, in terms of GDP, we're not using employment growth. We're looking at the growth in, or the movement, the increase in hours worked, because hours worked plus productivity is equal to GDP, and that's how the maths of it work. So there's been a modest increase in hours worked of about 0.9% over the last year. And so if we build a model on that, and that's in chart number 2, you can see the red line is the model based on, or the nowcast based on hours worked. You can see what it's showing is that growth is slowing down and stabilising at about that 1% of GDP, which is a really good thing, because even if some people criticise Jim Chalmers as not doing his job, it does show that the RBA is doing its job, because that very low level of growth that we have is what's called the narrow path. The growth is very low, but it is not negative. And that is what is meant by a soft landing, or the narrow path. So hopefully what will happen is growth will continue at this low positive but slow positive level. As it does so, unemployment will ratchet up. we think that unemployment will be around about 4.8% by the end of the year. And that high level of unemployment will put downward pressure on prices, downward pressure on wages growth, and that will bring inflation down to a level of say 3% or less, where the RBA, which has the lowest interest rates in the English-speaking world, 1% lower than the Federal Reserve, 1% and lower than the Bank of England, and lower than even the Reserve Bank of New Zealand, they can begin to cut rates. It may feel very frustrating in terms of the economy, but in fact, and certainly frustrating for some politicians, but this is the narrow part. This is the slight level of positive growth, which allows you to get inflation down with it and avoid a recession.